Brilliant. Jeff, stay with us because we've got a terrific guest coming up in a couple of moments. I know you're going to want to get involved. Thank you for that. The Fed says financial institutions are taking advantage of the central bank's crisis lending program, taking nearly $12 billion in short-term loans this week. The facility offers banks one-year loans in exchange for high-quality collateral. Barry Norris is the CEO of Argonaut Capital. Barry, thank you very much indeed for joining us. Look, let me get this straight. You were short SVB and Signature for 6 months prior to last week's news. So you've been on the ball on this story. You've been very sceptical of the strength of these financial institutions. First question I should ask you is, do you still have shorts remaining in the US banking sector?
Well, we still have positions in Signature and SVB because there's no trading in those banks yet, even though the share prices have been marked for zeros. And we also have, I would say, if you like, a basket of banks that we think are still vulnerable to what's going on in markets at the moment.
Barry, I had a strenuous debate just now off camera with my wonderful colleague Juliana. She was saying the vote of confidence in First Republic from these other banks. Personally, I was slightly more sceptical. I think actually it's a rounding of the wagons. It's trying to create a fire break between other banks, and maybe perhaps it was inaugurated with the Fed's very, very fulsome backing as well. Barry, do you think it's a vote of confidence in First Republic, or are you still deeply sceptical on some of these regional banks?
Well, I think that 30 billion of deposits is a small amount of funding for a bank that has got a far bigger balance sheet and one of the biggest balance sheets in the mid-bank sector. So I think that we'll see more funding for First Republic going forward. And I think the problem that First Republic has is similar to that Silicon Valley had, in that it's got a balance sheet with illiquid assets that haven't been marked to market, and they've obviously now got a fairly shaky deposit base which will struggle to fund those assets. So the problem is that when you lose your deposit base, you have to unwind the assets, and if they're loss-making in terms of mark to market, that leads to losses for shareholders.
Barry, good morning from Zurich. I understand you also had a short position in Credit Suisse. What are you doing with that position? Have you closed it in the light of the lifeline given by the SNB?
No, we're holding on to the position. I think the issue with Credit Suisse is obviously in the fourth quarter of last year, it lost 38% of its deposits in just one quarter, and the whole bank is in a wind down essentially, and whether that wind down is orderly or disorderly is the debate at the moment. None of which though creates value for shareholders, in my opinion.
Barry, when you look at what's happened at Credit Suisse, are you confident that it is an idiosyncratic issue, or are there other European banks that you are looking at that could turn up as a big risk as well?
Well, I think Credit Suisse is the outlier just in terms of its unstable funding from its depositors. There's no other bank that has had the deposit outflows of Credit Suisse, and I think what the market is concerned about is how those deposit outflows will have accelerated in recent weeks, and therefore can the bank meet redemptions of deposits with cash. And I think that's where the bailout from the SMBs is helpful in the short term, but still obviously is a question of keeping the show on the road rather than creating value for shareholders. I think in terms of the wider European banking sector, there will be different problems if Credit Suisse fails. And I think the size of Credit Suisse is the issue here compared to the US banks that we're talking about, and that it has a 500 billion Swiss franc balance sheet, which is twice the size of Lehman Brothers when it fails, and therefore is a systematically important bank. So I think in Europe the battleground is Credit Suisse, but if Credit Suisse has to unwind its balance sheet in a disorderly way, those problems are going to spread to other financial institutions in Europe as well, and also beyond the banking sector, particularly I think into commercial property and private equity, which also look to me to be vulnerable from what's going on in financial markets.
Barry, thank you so much for sharing your thoughts this morning. Barry Norris, CEO of Argonaut.